Ladies and gentlemen, boys and girls, children over the age of 18, this is Ortez, and that's Travis, and we're your favorite LOs. In today's episode, we're going to talk about all the don'ts that you have to do. That's kind of sound funny, but all of the don'ts that you want to make sure you don't do when you're actually in process to get a mortgage. So grab a pen and a piece of paper and your favorite beverage, and we'll be right back in a second to talk about those don'ts. See you in a few. All right, folks, welcome back. And as I stated in the intro, today we're going to talk about 9 don'ts that you want to make sure you do, I guess, or pay attention to when you're buying a mortgage. When you're buying a home. So that way you don't mess up your loan while it's in process. All right. So we're going to go ahead and get started with this. There are 9 of them that we want to take a look at. So go ahead and grab that pen and piece of paper so you can make sure you write down all 9. All right. So the first don't that we have to talk about, ladies and gentlemen, don't change your job or become self-employed or quit your job while you have a mortgage in process. Now, Travis, tell the folks why they don't want to do this in regards to a home loan.
Let's just go ahead and just state the obvious here. I mean, I think that most of our watchers are going to understand that you shouldn't just leave a job, right? This typically will come up in a situation where someone's presented with an opportunity where they think it might be the better option, or a better job. I can remember a time writing a loan for a client who was a visiting nurse, and she never thought that it would impact her in the way that it did when she decided a week before we closed to change jobs to a quote unquote better job. Some of those very unique, employment situations, like most of our nurses, you might not work 40-hour weeks, you might work 36. You never know how it's going to impact you. I mean, obviously, I think most of our clients are not going to go out there and have a good paying job and just quit their job and expect to close on their house. But changing of the jobs, that's sometimes a little bit where people get kind of tripped up. So anytime an underwriter is using your income, we have no idea whether or not that change is going to impact us as a client. So that's why you want to reach out to your loan officer, present them with the opportunity that you've been presented with, and let them know exactly how you're going to be paid. I can't tell you how many times we've had people, Tez, I'm sure you've ran into it, where someone says like, yeah, I have this new job, I'm full time. And then we run a written verification and the employer doesn't necessarily want to commit to you being full time. Although you might work 40 hours, people find ways around things, and sometimes it can trip you up. So anytime you're going to change jobs or obviously quit jobs, not going to be good, because we need the income to afford that new house.
No, that's spot on, spot on. And then by all means, folks, we're not saying that if a better opportunity doesn't come along, that you shouldn't possibly entertain it, but just speak with your loan officer. That way we can guide you. And then probably most employers, if you're explaining to them like, hey, I'm in the process of buying a home, is there a window in which I can, come on the board to this new job? More than likely they should be reasonable people to allow you to get you that time if they really truly want you as an employee. So the next one, number 2, don't buy a truck or a car or a van during this process. Getting a new vehicle while we're in this process is a completely bad idea. And I'll take this one here, Travis. So basically, folks, when you're buying a new automobile, like by all means, things happen. Cars die every day, ladies and gentlemen. But buying an automobile is a new liability that we have to account for now. And knowing how cars are today, you're not going to find $100 car payment. More than likely, you're looking at a $600, $700, $800 car payment that we're going to have to factor into your debt to income ratios. We'll probably have a link to a previous episode we did when we talked about debt to income, but that's going to be a new liability that we have to account for. And it just may kill the loan because it may price you out of the actual home that you have under contract. So buying a car of any magnitude is not a good idea. during the home buying process. I usually tell most of my clients, if you need to buy a car, can you Uber for a couple weeks until after we close? So then that way it's not that big of an issue when it comes to getting you in this home. All right. So I mean, I think that one's pretty self-explanatory, Trav. I mean, the biggest thing is the liability that it adds. Anything I might have missed when it comes to like, the automobile purchase.
Well, if you buy a van, make sure it's very big and you can live in it because you might lose your house over it.
Hey, remember the conversion vans that had the beds in them? I miss those.
Oh,
I miss
I
those.
remember. I remember vividly. Like one of my childhood memories is riding down the road and arguing with my sister whether we were going to be able to watch cartoons or whether we had to watch like something like Little Mermaid on the television. Remember, like the television and the floor. Man, those were the days.
Sorry, folks, we were dating ourselves just there. All right, so we'll go into we're gonna go ahead and get into don't number 3, and that's don't use your credit cards extensively or let your current accounts fall behind. Now, Travis, tell them why this don't is really important when it comes to the actual mortgage process.
Well, I can tell you that oftentimes if a client is going to be extremely close on debt to income, there's sometimes going to be some monitoring put in place by the underwriting systems where they're going to go back and they're going to verify certain debts. So if we go crazy with a credit card that we already have, and let's just say our minimum payment goes from $40 a month to $250 a month, we might have a ratio problem, right? And other times, one of the things that we see a lot is in today's market, it's taking people a little while to get their offers accepted. Credit reports expire. So what you'll see most often is if we max out debt or if we increase debt while we're in our pre-approval period, and then we have to, pull an additional credit report to get us to the closing table, oftentimes credit scores can dip. So, I think that when Tez and I were talking about all of the don'ts here, it's like we were going to say it's do's and don'ts. It's mostly don'ts, but the one do that you hit on is do make sure you keep your bills on time, right? Because obviously we want to make sure that there's not going to be any drastic changes in the credit score or the ratios while you're in process.
Awesome, awesome. I don't nothing to add to that, so I'll go ahead and hop into number 4. Number 4 is don't originate any new increases on your credit lines. And the biggest reason why you don't want to do that, correct me if I'm wrong, Travis, is it comes down to the usage. So increasing those credit lines to make it seem like you have more may actually be a detriment to you when it comes to the usage and usability of those actual credit accounts. So that one's a pretty short one in it when it comes to that. Don't increase your credit limits. Just leave them where they're at while you're in process. So nothing is a snafu when it comes to that. Hop into.
You also
Oh, go ahead, Travis.
I'm sorry. You also want to make sure that every creditor is unique in the fact that some will offer a credit increase at your request without accessing the credit. Other times, when you ask for that increase, they're going to hit your credit. Now we're getting a trigger from an underwriter saying, Mr. Smith just had his credit pulled. What is that? So, like like Ted said, it could be a nothing, but it could also be a snafu. We don't want snafus.
Yeah, and I mean, just to piggyback off that, because if the credit report is pulled, they want to know if a new debt or liability has been added that's not on the credit report. So then a verification, or excuse me, a letter of explanation needs to be written, and that's just more paperwork and more things that we just don't want you to go through in the process, because we all know how tedious it is. That hey, it's a lot of documents. We just try to make it as easy as possible for folks. So don't increase your credit limits while you're in process. Let's see. Number 5, and this one I'll actually I'll dime this one off to you, Travis. Don't make any huge deposits without verifying them with your loan officer. Now, someone might say, "Well, what's a large deposit and why does it matter?" So, Travis, kind of break it down why it's important when it comes to huge and large deposits.
I mean, the long and short of it is that the money that comes into the bank when you're in process and right before you go into process, because keep in mind, depending on the product, your loan officer might be asking for 1 month bank statements or 2 months worth of bank statements. Anything that comes in is actually far more scrutinized than anything that goes out. I get people all the time that are like, "Oh my gosh, like I spend so much money on DoorDash. Like, is that underwriter going to be upset with me for spending that money on DoorDash?" And we always think about the money that goes out, but the money that comes in is also very important, right? Probably one of the biggest reasons in which is unsourced money, right? Keep in mind that essentially you're going to be working with either Fannie, Freddie, FHA, VA, USDA. The government has their hands on Fannie and Freddie, and the government is FHA, VA, USDA. They want to basically know, have you paid taxes on this money? Where did this money come from? And the question we get a lot of times is, what constitutes a large deposit? Well, oftentimes, like a good rule of thumb is if it's more than half of what you make in a month, it's a large deposit. Okay. Now, keep in mind, you can also get hit for a series of deposits. So, no, you can't just take $500 to the ATM 5 nights in a row. It's just the same as depositing $2,500. Most important reason for this is that we always have to assume the worst as loan officers and underwriters. So, they will assume that this money came from somewhere that you're hiding, right? And at the very best, you're going to probably create yourself a paperwork nightmare, right? So just make sure that we're keeping track of things. And that's not to say that, people don't make large deposits while they're in process for very, reasonable things. A lot of new couples, right? You get married, you buy a house. It's like part of the process, right? But understand that when we go make that deposit for, some of you guys are extremely lucky, $10,000, $15,000 from your wedding gifts. We do expect to be asked about that. So quite simply, the money out doesn't matter as much as the money in. And let's just make sure that we're having conversations with our loan officers in advance before that money hits the bank so that we can make sure that those are from verifiable sources and let you know what you're looking at as far as documentation goes.
Okay, and then the only thing that I would probably add to it is mainly kind of folks talks is going back to mattress money. I know how some folks don't trust the banks, and I don't, disagree with them, especially with all the banks, the Silicon Valley Bank collapsing and things of that nature, how hard it might be to get your money out. But talk to your loan officer if you do got mattress money, so that way they can best guide you, and talk about the seasoning process with you. So that way we don't have to run into that nightmare of that large deposit, in that regard. So that's the only thing I'm going to add. And that's kind of going to transition. It's funny into the next one. Don't, what's this? Number 6. Don't change bank accounts, ladies and gentlemen, while you're in process. I'll take this one, Trav. The reason being is because we need to verify those funds via a bank statement. So if while you're in process, you're changing bank accounts, typically when you open a new bank account, there is no bank statement to support the funds that you have in that account. So that can cause a paperwork nightmare because typically most banks don't run a bank statement for 30 days after you open the bank account. So if you're in process and you think about changing banks, wait until after you close on your home loan to take the money out and put it into a different bank account, okay? And then also, by changing bank accounts, if they verify those funds in that previous account, the lender is expecting the funds to close to be wired from that account. So they will verify where those funds came from. And if they're not from the same account in which they verified, that's going to cause a nightmare at the closing table, ladies and gentlemen. So, number 6, don't change bank accounts. Travis, is there anything I may have forgotten in regards to changing bank accounts?
Pretty straightforward. I've had people that have had all good reasons for changing bank accounts. Just understand, that it's just an unnecessary step at that point. It can almost always wait, 30 days to get you closed.
Okay, awesome. So, number 7, my friend, and this is the one I run into this so much. Ladies and gentlemen, do not co-sign for anyone. I don't care who it is. Unless you're married and you guys are on a car together, don't co-sign for anybody. And Trav, I'm going to go ahead and lob this one up to you because it's a pretty straightforward one. Why don't we co-sign for anyone when it comes to buying a home mortgage, purchase?
Because by and large, that will end up being your debt. Okay, now there are a million and one ways where the loan officer can attempt to have that debt excluded from your debt to income ratios. But far too many times, people don't truly understand what they'll need to do to prove that it's not their debt. Okay. The biggest one we run into every day is cars. Okay. You know, the guy at the car dealership says, it's no big deal. You're just co signed. So, number one, it's absolutely a big deal, especially if that person doesn't make payments on time, because that hits your credit just as hard as any other debt. Number two, if they do make payments on time, I mean, Tess, how many times have you seen someone, let's just say, you know, oh, well, I purchased that, I'm a co signer on that car for my child. And then we go through the process to try to exclude that debt. And we find out that that child is making payments out of a bank account that also has that parent's name on it. Right. So yes, like the short answer is just don't do it. Don't assume that anyone on the loan side of things is going to be able to undo that decision, because I've seen people that have done things with the best of intentions and it's ended up getting in their way. At the very least, again, goes back to more paperwork, more things for you to have to go through. This process is already going to be something that you, let's just call it, you're going to stress about it. Tez and I work as hard as we can to make this process easy and enjoyable, but people are stressful because it's a stressful situation, right? You're making a huge purchase. So I think Tez really hit the nail on the head. Short answer, don't do it. Just don't do it. It's not worth it.
No, ladies and gentlemen, it's not. It's not. And yeah, it was funny that you were saying that about the child. I mean, the worst has to be if the child gives the parent the money and the money comes out of the parent's account. Then it's just like, well,
Oh,
you're technically paying for the car, so it's your car. So yeah, ladies and gentlemen, don't co-sign for anybody in that regards. And that's going to take us into don't number 8, and that is don't omit any debts or liabilities from your loan application. And I'll go ahead and run with this one because, and you might just say, hey, well, what debts and liabilities would I be omitting? Right. Well, so some of the debts could possibly tax liens or taxes owed that you have to pay. Any alimony or child support or separate maintenance that is a debt that you are liable for. Um, let's see, like I said, sometimes things that you may have just made a purchase and it's not showing up on your credit. So any new credit inquiries, we're going to ask like, hey, did you open any debts? The reason being is you don't want to get in the process, be approved for a mortgage, and then when they find out this other debt is there, it actually kills the loan. So letting the loan officer know upfront of all of those things that you're obligated for will help us navigate when it comes to figuring out your debt to income and making sure we're giving you a proper pre-approval when it comes to actually purchasing a mortgage. So omitting debts and liabilities is only hurting yourself because that's not actually painting an accurate picture that we use to help with the debt to income to get you qualified, ladies and gentlemen. I'm sure there might be some other debts and liabilities, but I mean, that'd be for another day and another conversation. But the biggest thing is, ladies and gentlemen, be transparent with your loan officer about the debt obligations that you do have so that we don't run into this potential nightmare down the line. Trav, did I miss anything when it comes to the obligations and liabilities?
the only one that I run into quite often is, if you borrow money from yourself, like a 401k loan, sometimes people forget that that has to be paid back in a certain way. Most oftentimes we can see it on the pay stubs, but don't assume that someone's not going to miss that someone will always catch it. So just be transparent up front. Like Ted said, it makes your life a lot easier in the long run.
Yeah, and then another thing that we look at, like ladies and gentlemen, when you turn in bank statements, we look at everything that you're charging off, right? Everything that comes out of your bank statement, we review. So it's kind of hard to kind of hide that. So we'll see it. So just go ahead and be upfront and transparent about it. So then that way we can do right by you, ladies and gentlemen. And that'll bring us to the last one, ladies and gentlemen, number 9. And it's funny because I saved it for last. It's one of my favorite ones. Ladies and gentlemen, we know you're getting a new house. Do not buy any furniture for this new house until after you close. We know how enticing it is to go to that showroom to look at that new bed set. Ladies and gentlemen, please don't do it. I'm gonna give it up to you, Trash, to try to close it out and tell them why buying furniture before close is a bad idea.
Every loan officer that I know that's been in the business more than, let's just say, 2 years has had something similar to this happen. And almost all of them have had a deal that they've lost because of it. Most often, when you go in there and you're checking out the beautiful furniture, they're going to sell you on financing. Most oftentimes, this means either a new debt or a new credit line and a new debt. So, if you got someone that wants to help you out, mom, dad, significant other, someone that's not on the loan wants to buy you that stuff to make sure that it's delivered on closing day. That's something you can talk to your loan officer about. But absolutely, furniture is probably one of the biggest ones that we see. Like a client's like, well, the lead time on this is like 2-3 months. I'll never forget when I moved into my last house. We sat in like almost like the pop up, like almost like lawn chairs for probably a couple of weeks because of the same thing that we just talked about. Is that we didn't order our new furniture until we were closed on our new house, so we had to wait a little while. It was a funny story to share with people who came over. But I got to share it inside the walls of my brand new house instead of back at the apartment that we were in. So furniture can be dangerous, guys.
Yes, very dangerous, ladies and gentlemen. And that'll pretty much wrap up our don'ts when it comes to buying a home that you don't want to do while you're in process with getting a new home loan. So that'll wrap up this episode, ladies and gentlemen. If you found it beneficial, please go ahead, hit that like, subscribe, as well as that bell notification so that every time we update you guys with new knowledge, you're aware of it. But with that being said, my name's Ortiz. Again, that's Trav, and we are your favorite LOs. Till next time, folks. See ya.